Welcome to HYSA Wars, Rate versus Convenience. In this video, we will explore whether chasing the highest advertised APY is actually worth it for most savers, and why integration, usability, and institutional stability often create more real-world value than a marginally higher rate. To set expectations, we will compare rate chasing with a convenience-first approach, show simple calculations, and provide a practical checklist. Now, to set the stage clearly, let's move into today's agenda. Here is our roadmap for the video. First, we will dissect the rate-chasing trap. Next, we will highlight the underrated value of integration and user experience. After that, we will cover key checks before opening a new high-yield savings account. Then, we will walk through quick, illustrative calculations. We will also include quizzes to reinforce learning. Finally, we will wrap up with actionable next steps. With this outline in mind, let's begin with a brief but important disclaimer. This video is educational and does not constitute financial, legal, or tax advice. All savings account rates are variable and may change at any time. You should verify FDIC or NCUA insurance, review the terms and conditions, and consider consulting a qualified professional before making decisions. With that foundation in place, let's transition to understanding the rate-chasing trap. Rates on online savings accounts are variable and can change quickly, often following Federal Reserve policy and competitive moves. The top APY today might not be the leader next week. Chasing a small bump, such as an extra 10 to 25 basis points, usually introduces friction. Additional onboarding steps like identity verification, linking accounts, and setting up funding. It can also create administrative burden, such as managing multiple accounts and receiving multiple tax forms, like 1099 INT. Over time, the marginal gains can be offset by the effort and the opportunity cost of your time. Therefore, many informed savers focus on institutions with consistently competitive rates and transparency rather than chasing temporary peaks. With that in mind, let's move from the problem to the alternative, prioritizing integration and usability. Integration provides tangible benefits. Using one application and a single set of credentials reduces complexity and improves security oversight. Transfers between linked accounts are often instant or nearly instant, reducing the need to wait for funds. Additionally, institutions offering no fees and no minimums minimize the erosion of your earnings. Unified dashboards and alerts enable better visibility and quicker decisions across checking, savings, and investments. The overall convenience and reliability can easily outweigh a marginally higher APY elsewhere. Next, let's formalize how to choose in a more structured way. Here is a quick, actionable process. First, check a rate aggregator to see the general top-tier range rather than fixating on the single top listing. Then, filter out accounts that have maintenance fees or minimum balance requirements. Next, research the provider's historical behavior. Do they tend to track the market consistently, or do they spike and fade? Confirm transfer speed and reliability to your primary checking or brokerage. Verify FDIC or NCUA insurance, and read the fine print for limits and policies. Assess integration benefits such as budgeting tools, alerts, shared login, and support. Finally, decide whether the uplift in rate is both meaningful and likely to last. With the process in hand, let's support it with a simple table of key checks. This table summarizes the most important checks. Confirm the institution remains competitive over time, not just in a single moment. Prioritize zero monthly fees and no minimum balance to avoid eroding returns. Evaluate transfer speed for timely access to funds. Consider integration benefits to reduce the administrative load. Verify applicable deposit insurance coverage. Lastly, promotions or bonuses can be helpful but should not override long-term suitability. Now let's compare rate chasing versus a convenience-first approach side by side. On the left, rate chasing targets the highest available APY at a given moment, but leadership often shifts. This can lead to frequent opening of new accounts and moving funds, which increases complexity, creates multiple logins, and fragments alerts and statements. Tax time can bring more forms to reconcile. The time cost and potential for errors can overshadow the marginal rate advantage. On the right, an integrated approach favors institutions that remain competitive and offer a cohesive experience. Fewer accounts, faster internal transfers, consolidated notifications, and reduced friction. This often results in better long-term outcomes for most savers. Next, let's check your understanding with a quiz. Quiz time. If a new HYSA offers an additional 0.25% APY over your current account, which factor should most savers weigh most heavily before switching? Option A. Whether the higher rate will stay competitive over time and the total hassle cost. Option B. The color of the bank's mobile app. Option C. The number of billboard ads you have seen. Option D. How many friends opened the account last week? You may pause the video now to think about the answer. We will discuss the correct answer in the next section. The correct answer is A. The durability of the rate and the full hassle cost time to open the account, link, transfer, and manage additional administration are key. A small lift can be quickly offset by these factors. Now let's continue with a second quick quiz. Second quiz. Which combination most often produces better real-world value for typical savers? Option A. A slightly lower but competitive APY with strong integration, fast transfers, and no fees. Option B. The absolute highest APY with slow transfers and multiple fees. Option C. A low APY with high fees but an attractive logo. Option D. Any account that was number 1 this week. You may pause the video now to think about the answer. We will discuss the correct answer in the next section. The correct answer is A. For most savers, the combination of strong integration, fast transfers, and no fees tends to create more reliable value than a marginally higher rate that may not persist. With that clarified, let's make the trade-off more concrete with a quick calculation. Consider a simplified example. If you have $10,000 in savings, an additional 0.25% APY amounts to approximately $25 per year before taxes. If the account opening, linking, and fund movement take around 2 hours in total, you should value your time accordingly. Add in potential delays due to transfer holds or additional verification, plus the burden of tracking another tax form. If your current institution adjusts its rate upward shortly after, the gap may quickly disappear. This illustrates why small rate lifts often do not justify the practical friction. To visualize the broader dynamics, let's look at a timeline of shifting rates and behavior. This timeline illustrates how APY leadership rotates through the year as policy and competition evolve. A challenger bank may lead briefly, but incumbents often catch up. If savers jump repeatedly during spikes, their transactional and time costs can persist even as the rate advantage fades. A steady, criteria-driven process usually outperforms reactive switching. Now let's complement this with a high-level breakdown of value drivers. This pie chart frames value as a combination of a competitive rate, strong integration and user experience, and favorable fee and policy structures. While the exact weights differ by person, the key point is that the APY alone is not the sole determinant of value. Integration and low fees work together to preserve and enhance your effective return. With the big picture in view, let's capture the essentials as key takeaways. Here are the core takeaways. First, accept that rates are variable and leadership changes frequently. Second, small APY improvements are often offset by friction and time costs. Third, integration with fast transfers and no fees tends to create superior long-term outcomes. Fourth, use a checklist and only switch for gains that are both meaningful and likely to persist. Finally, remember that simplicity is a feature that helps you avoid errors and maintain momentum. To close, let's summarize and share a next step. In summary, avoid chasing every rate spike. Instead, prioritize institutions that remain competitive and offer a cohesive, low-friction experience. Confirm zero fees, no minimums, and appropriate deposit insurance. Only switch when the benefit clearly outweighs the costs and is likely to persist. By safeguarding your time and simplifying your setup, you protect not just your yield, but also your focus. Finally, let's wrap up with a quick call to action. Thank you for watching. If you found this helpful, please like the video, share it with someone who is weighing savings account options, and subscribe for more practical personal finance breakdowns. In the comments, tell us your HYSA strategy. Do you chase the rate or prioritize convenience and integration? We look forward to your thoughts. See you in the next video.